The near-term pullback we expected from Wednesday's video has played out over the last 2 days and produced a bullish, short-term bullish bounce signal. So I'm going to break down what that signal is. What can we expect now on Monday and Tuesday based on that signal? What was today's primary driver in the market? How does that impact trends going forward in terms of how we manage our portfolio? And the trade idea in an area that can struggle from that. That will be impacted by today's bigger moves. So let's go ahead and get started. Today is Friday, July the 20th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you for tuning in tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo in the bottom right corner of the video. Click the red subscribe button that pops out there. Click the thumbs up icon down below the video. You can do that right now while you're watching. That tells me two things. You like the video tonight, you want us to keep doing these. And then comment down below on anything that stands out to you. What did you learn? What did you get out of it? What thoughts do you have on it? Comment down below. There's a link popping out in the top right corner of the screen. That will subscribe. If you click on that link, that will subscribe you to our daily Market Outlook email list. Remember to follow me on Twitter if you haven't already for more content like this throughout the day. Join our Market Outlook community on Facebook. All right, well, let's start off. You're looking at the S&P 500 with the market forecast indicator. Obviously, a two-day down day here, losing streak, coming off of that overbought cluster that we had on Wednesday. We talked about on Wednesday's video that that probably not going to produce an intermediate pullback like we had right here that produces the pink shadings. The pink shading comes when the green line falls below 80, and of course the darker pink when it falls below 50. Probably not going to get that. Of course, anything can happen, right? But the expectation is once it crosses above 50, then we get 1 to 3 months. And to get an overbought cluster like that, that's a pretty good sign at the beginning of an intermediate run. Not a good sign at the end of one when you're 2 to 3 months in. Green line's been above 50 for 2 to 3 months, but a good sign at the beginning of one. And we did talk about on Wednesday that at least we could expect a near-term pullback. I kind of expected that would occur after expiration. This simply according to the seasonality. But remember, the 18th was actually the pinpoint of that seasonality. On average, it happens to be around expiration. That's why I was pointing towards Friday. But that's the date of the highest point of the year in July before the end of the year on the last 20 years on average. So it worked out this year. We got that near-term pullback immediately. A near-term pullback meaning the blue line pulled back below 50. The intermediate line, or momentum line, excuse me, in red pulled into the reversal zone for a second day. This time, see, yesterday we had what's called a bullish intermediate confirmation signal, which is a strong bullish posture according to the intermediate line, and an oversold momentum line down here according to the red line. That is a bullish short-term signal. Yesterday, the near-term line was not below 50 yet. It was still up there. It's like 11 days up there. Today, we got a second day with the momentum line in the reversal zone. But today, we have the near-term line below 50, setting up the potential for a bullish near-term low point. What is a bullish near-term low point? See, the last time the near-term line got below 50 was over here. The corresponding low is right there. Obviously, that would be a higher low point if this is a near-term low. And it would be a bottom between 20 and 50 on the near-term line. Usually, on average, about 1 to 3 days is when you're on a bullish trend. Is how long the near-term line stays below 50. Of course, if we sell off sharply below these low points on Monday, then things can change. But that's not what we expect, right? We expect, according to the pattern, that we'll start to bounce up. Now, next week's a big week, earnings and all sorts of things. So. They're on average, from a seasonal standpoint, next week's a pretty bearish week and into the end of the month now that we've kind of hit that peak. But like we saw last year, we didn't go down post July expiration. We actually stayed pretty flat with all these tech earnings coming out. So they might be the fuel if these earnings are drive prices higher for these bounces, for that short-term bounce that the market forecast is suggesting that we should expect early next week, Monday, Tuesday, kind of a thing. You know, there might be another quiet day on Monday. Mondays typically are pretty quiet. We might fill in the rest of this little range in that bigger candle right here with another slight down day, small enough to keep the near-term line above the 20th percentile, maybe dipping its toe below, small enough to keep the momentum line from dropping to an extreme low, so it might actually bounce up a little bit, and still keep the intermediate line above 80, because you can see it's above 90, so you know that's not going to drop in a day. So we might get on Monday a slow day before Tuesday we bounce again, according to this pattern that we're seeing right now on the S&P 500. If you look at the Dow Jones Industrial Average, same pullback, same pattern, right? You have, or excuse me, here we go. You got the intermediate line up above, almost above 80. It's still bullish. The momentum line did bounce, so this is what could happen on Monday on the S&P. Even though we had a down day, so it did bounce. Near-term line fell, setting up bullish near-term low point, possible bullish near-term low point. Nasdaq Composite, same pattern, strong bullish posture, oversold momentum line, but not to an extreme. Didn't drop below the 5th percentile. Near-term line falling below 50. Russell 2000, again, all coming off of these overbought clusters. 2-day drops, same pattern. Oversold momentum line, strong bullish posture, potential for a bullish near-term low point. Let's see. That's the S&P 500. Here we go. The Russell 2000. The intermediate line rising up above 80. So it's amazing how they have similar patterns when you're looking at this exact same chart. The Russell 2000 here. This one's a little different. This one is a little different. I did talk about this actually in my class, my technical analysis class this morning on Market Scholars. The near-term line had already pulled back. See, on the S&P, we didn't get this pullback on the near-term line, and the Dow and the Nasdaq. The Russell we did. So during this little run, the Russell's been a little weak while the dollar's been rising, and you know, and the trade wars and all of that. It's kind of impacted this here in the short term. But then we bounced. We held support, Fibonacci support, and we bounced. A little bit of a cup and handle formation forming here. That is a bullish pattern that you'd expect to break out above those highs. The near-term line's only been above 50 for a few days, and it's still, the near-term line is actually still not only above 50, but it's also above 80. So, you know, we're just starting a near-term run on the Russell 2000, which again kind of shows, kind of would lean us, continue to lean us more towards that bullish bounce developing on all the other indexes starting tomorrow, Monday. If not Monday, if we do end up with a small down day on Monday, most likely Tuesday, once we start getting all the news that can impact and influence stock prices. Now, before we look at other charts here to either confirm or not that posture, I just want to remind you that you can watch the Market Outlook video from the Market Scholars website on our blog. You can see here's the post, the last post that I did. You can see our class schedule, the upcoming class schedule, as well as all the events over here on the right. And you can subscribe for free to our site to see some of the and participate in our forums, especially including the Market Outlook forum. There's a link right here up above the video. But what we ask from you is for 3 clicks here, and the 3 clicks give us the feedback whether you like the video and whether you want us to keep doing the video. And those 3 clicks are: 1, here, to like tonight's Market Outlook tweet on Twitter. If you have your Twitter account, you don't even have to go there. You can click it right here. That will like that tweet. Click on this image. That will take you to your Facebook, facebook.com. If you have a Facebook account, you can like tonight's Market Outlook post there. The more you like those, the more Twitter and Facebook will continue to push that post out to people who follow me and people who like this kind of content. And then finally, you can like it right here just below. So 3 clicks. You can do it while you're watching the video right now on this page. All right, back to the charts, and you can see we continue to trade. We finished the week above a rising 50-day moving average, which is above a rising 200-day moving average, and the gap between the two, which is measured down here, is rising as well. So bullish patterns. Now keep in mind, if I were to change that MACD down there and change it to measure how far above that 50-day moving average or 10-week, which is what we're looking at here, We are relatively high, and that's kind of why we're running out of gas. The upper bound for this MACD is right around 60 some odd points. And so you can see we've kind of hit that level, and we've done that before, and that's when we start a little bit of a pullback. So we'll see if that ends up playing out. It's a little bit more short-term weakness, or if we can pull up a little bit higher. You can see the, during this rally here in 2016, during those long-term bullish moves, we got about 70 points up above the 50-day moving average before we flattened out and ran out of gas. So, and you can see that's the time of year, right now in July and August, where we get up this far and we kind of flatten out with a slight bullish bias because we remain above that 50-day moving average there. If you look at the 3 green arrow chart, so it's, and again, you can see we're pulling back on the momentum, so we're losing positive momentum. The buyers are still in control according to the stochastics. We're above a rising moving average. So green shaded, so we're shaded green here. We're shaded green on the market forecast indicator, here, and we're shaded green on the across the long-term chart. So bullish from the long-term and intermediate-term perspective, bullish across the board. Quiet summer days on July look like this. Look how small today's range was on the intraday chart here. Completely inside yesterday's range. We did close at the low, so again, maybe another day of weakness on Monday, but probably won't drop below that low point, which is that's the body of that larger candle from Tuesday, where we rallied up. So probably in this area here, if we continue to have some weakness, you can see where there's a lot of trading in that area. We'll probably trade into that point with a small quiet day. Again, barring any unexpected news coming out over the weekend, because that's what Mondays typically are, especially in the summertime, just quiet days. Usually not a lot of economic indicators or earnings that come out on Monday, especially before the market opens. You can see here that if I were to look at today's small range today, very small range, the volume was a little bit above average. So a little jump in volume up to 82 million above that 4-week average point. Going back here really quickly to this chart, you can see the range right here below less than half the range. If you look at the actual ETF, the average range is 2.2 points. We were below 1. So if I show you this chart here, there's the ATR, so we're below 1. So that's where my cursor is. That's how low today's range was. Volume was at 82 million, so that's a little bit above average, but still relatively low according to the 52-week range of that average. And then the ATR relative to the price remains in bullish zone, in the bullish area, so 75%, and has been a lot smaller than that before. So let's look at a longer time frame here. You can see, over the last few years, especially in 2017, look how low the ATR got relative to the current price of the ETF up here at the top. That's what this ratio measures. So when you're below 1, that's bullish. When you're above 1, that's a bearish. That's when you're more bearish. And you can see, the last time we were dipped our toe above 1 was right before the election, and then it got into bullish zone, and then again at the end of this year, you can see how high the ranges got, big spike in ranges. But the ATR on an absolute basis is still actually higher now than we were back here. So there's still room for the absolute ATR to continue to fall. Remember, when it falls, that's bullish. It's not bearish, it's bullish. And volume, as high as it is right now, you can see it's been, this is bullish zone. This area where we spend most of the time is still relatively low. So bullish on an intraday chart and bullish on the volume. And then finally, the last thing, I was going to go back here to the intraday chart. We're trading in the upper half of the zone, so positive development from that perspective. And then the volatility. When you look at the VIX relative to the VIX 3M, which is the 90-day volatility, we're right in the sweet spot of the bullish zone there too. So yeah, we might get another day of weakness on Monday, but a lot of these charts are suggesting that we don't need to be too bearish. If we do, and that we end up with a 3-day losing streak, we shouldn't necessarily start backing up the bearish truck, so to speak. All right, with that said, summarizing the market posture, the trends are still intact. The long-term intermediate trend still bullish. The short-term, we're getting bullish short-term bounce signals, kind of buy the dip signals that may not necessarily play out on Monday. They could, but may start playing out starting on Tuesday next week when we start getting the drivers of price volatility. Now remember those. We're entering a bearish seasonal time frame for stocks from a seasonality standpoint on average over the last 20 years. But the current environment suggests that we may, at worst, kind of trend sideways like we did last year during this time, the week after expiration, July expiration. But at best, take off and move a little bit higher because of how bullish we are across all these different charts that we look at in our study set here in our routine. So what do you think about the current market environment? So there's a link popping in the top right corner of your screen. Click on that link. I will open up a poll. So either click, do you agree with our market posture today or not? If you click that disagree button, then scroll down to the bottom on YouTube here and comment down below on what you see that would suggest that we are more bearish than this. And love to hear what you're looking at and what your opinions on that are based off of. All right, now let's move into what's driving the price action for today. We've developed our market posture. Let's take a look at the kind of what's leading it from a macro perspective. You can see nothing on the calendar today. That's why it was such a quiet day. We did have obviously Trump. The administration having some comments and tweets for that matter, but comments in an interview about China, about the European Union, and about currency manipulation and the Fed and the raising rates. What he believes kind of undermining the fiscal policies that have been put in place here. So, whether you agree or disagree, the markets reacted, and that's what we're here to talk about, is how the markets reacted. You can see I've got the different asset classes, some of the major asset classes here on the chart, different equities up here across the board. Here's ACWI, which is 60% US, 40% international. You can see stocks are pretty flat right now globally. You can see real estate stocks have been pulling back to support. Looking like they trying to find an area to bounce off of here. Preferred stocks are bouncing, so we had a good day yesterday in preferred stocks. They're bouncing up higher. They tend to do well when bonds start to pull back. Bonds broke big time today. Long-term bonds broke down below multiple weeks lows here. So big breakdown. Foreign bonds also pulling back here. You can see crude oil is trying to find a low point and bounce up. Agricultural, all of these which have been so beat up from that strong dollar. The dollar pulling back as much as it did today is leading to some bullishness here in the alternatives in gold as well as in agricultural prices, and over here you can see crude oil starting to bounce off of what would be a higher low point. For crude oil. So you see the impact. If you look over here, the dollar had one of the worst performances today among the different assets, different types of stocks, kind of breaking out some of these areas in stocks and bonds. You can see the dollar was down. MLPs didn't benefit from any move in crude oil, even though if it was a minor upward move. There's your real estate stocks, again trying to figure out that support level. But look at long-term bonds. I mean, the worst performance, and which means yields are bouncing up and moving up sharply. On the other end of the spectrum, that weak dollar had a really strong impact on EEM. International stocks bouncing up. You'll see that here in just a minute. And then there's your commodity basket also benefiting from that dollar. And then, of course, with interest rates rising, you can see preferred stocks also bouncing and moving up higher too. And then there's your other international areas. So, from here on, you can see the impact on the falling dollar and rising interest rates. If I take a look at here the 10-year yield, and you can see the bounce it's had this week. So getting back up above the 50-day moving average. 3% is a significant area here for it to cross over. If we were to cross over this 3% and stay, we did briefly here and we didn't stay, and that was bearish. But if we were to bounce up and get above 3% and stay, that would be significant for the direction of yields. If you take a look at the 30-year, which is more tied to economic growth expectations, you can see bouncing back up above the 200-day moving average and the 50-day moving average today. Those two lines have been converging, so a very strong move, and the equivalent level there is about a little bit between 3 and 3.25%, about 3.2% would be the significant level there. Any breakout above that from a 10-year basis, you can see would be a sharp move higher. A little bit of a cup and handle developing there on that on the 30-year too. So those yields rising. That would help that falling inverted yield curve, the yield curve, the 10 minus the 2s. It's been this week's had a bounce because these long-term yields are starting to bounce up too. You see the short-term rates, and I talked about this today in technical analysis too. They've been going up, and with this going up and the 10-year dropping, it's not been a good development. This has been going up. With all the interest rate hikes, and the range right now is 1.75% to 2%. That's your range for the overnight interest rate. So we're kind of in that range right now for in fact, the effective funds rate, I believe, is at 1.9%. So, you expect it to be a little bit higher. This is 90 days instead of just overnight. But you can see that's a bearish candle there. And if the 10-year yield continues to climb higher and faster than this, then you'll see that yield curve start to slow down its descent and bounce like it bounced this week. Not that an inverted yield curve will produce a bear market tomorrow, but as I posted in my blog post about expectations of what we can expect once we do get an inverted yield curve, but the fact that it is slowing down and bouncing up, that has been a headwind for stocks, this looming inverted yield curve. So a bounce back up will push like large cap stock. You would expect large cap stocks to benefit in that kind of environment. So when you look at the foreign market environment, you can see all these international stocks, just how bearish they've been. The U.S. stock market is really the only one that's been above a rising moving average here and has that strong posture. You can see over here on the left, it's the only one that has an intermediate line. Where's the SPX? It's up to 93.61. So not showing here for some odd reason. But look at what benefited. Look at what rallied today. Brazil bounced up. It's now above a rising moving average and has a strong bullish posture. China bouncing up off of that low point, a little bit of a divergent low point here. Very strong move higher. You can see Japan and Korea also moving higher in sympathy there, regional sympathy. You can see India, another emerging market, bouncing up, and then Russia, of course. You can see it's Russia bouncing up too. These two haven't been as bearish as China and Korea, but it looks like they're kind of holding, and it's got that potential to move up higher. From the European perspective, they lagged. They still beat the S&P. The only one who did not beat the S&P today was Germany. Germany down below falling moving average. But Italy rising a little bit. France is one of the best performers in that region. UK also bouncing up here. Of course, Canada has been more bullish, than a lot of these German areas, and it outpaced the S&P 500. So the S&P was down today, but all across the world, the markets were cheering the drop in the U.S. dollar. All right, now we look at the sectors and how they performed today. I've changed the watch list over here on the left. Staples Technology. Staples was really the only stock that moved, that had any kind of significant move to the upside today. And you can see it's got a strong bullish posture, and it's above a rising moving average. So good sign for that safe haven area. Preferred stocks, interest rate sensitive stocks that are bought for their dividends. You can see the benefit, from those falling yields and rising rates. These stocks rallying too to help support that. On the other end of the spectrum, these other interest rate sensitive areas all lagged behind the most. So Staples was able to hold up, and these corporate, these individual stocks with their yields holding up, but these kind of utility, real estate, and telecom areas that have those kind of higher high yield, so to speak, yields not holding up so well. In fact, they really struggled the most during this bond sell-off today, which is what you'd expect. You actually would expect Staples down here too. It's typically interest rate sensitive as well, but like I said, preferred stocks and Staples, they're not necessarily high yield. These are more of the lower yielding areas, within the dividend area. They benefited from this drop in the bigger yielders that typically have the higher yields. You can see what else. Pretty much everything lagged the market today, including those areas. But there's consumer discretionary. These two, interesting to see energy and materials both lagging behind as well, because when the dollar drops, those two areas do well. So don't expect, if the dollar continues to drop from this price pattern that we're seeing, this bearish price pattern, this price reversal, is in this head and shoulders pattern. And then today, that's a bearish candlestick pattern there. Evening star candlestick pattern. That's a better evening star. That one looks better, more picture perfect. This one, a couple of days in between, but that long upper shadow, I talked about that in my portfolio management class yesterday. That was a bearish sign. In fact, we kind of compared that day right there to Rocky 1, right? Where Rocky, the dollar actually rallied yesterday, like Apollo Creed won the fight at the end of Rocky 1, spoiler alert, but not without Rocky beating the crap out of him. So it was a tough day for the dollar, but it still won the day, just barely. But you can see here's Rocky 2. So Rocky beat the crap out of Apollo Creed in the next fight. So there we go. The dollar turning around, the intermediate line turning down, the near-term line coming from a bearish high point with a divergent high. So bearish signs for the dollar, and we've seen the impact that a continued bearish move on the dollar would have on equities. You can see from a sector rotation, these two areas, you would not expect them to continue to be weaker. If the market stays bullish, then those two areas would do well in a bullish market that also has a falling US dollar. So here's materials and there's energy. See how sideways they are, expecting to break out of that sideways action with a continued downward move in the greenback. So for our trade idea tonight, I want to look in this utilities area, which obviously would not do as well in a bullish market for bonds, especially for long-term bonds and bearish market for bonds and rising yields. You can see a stock like NextEra Energy, it already had a relatively bearish week last week. Now that's a bearish candle, not as bearish as it would be bullish if it was at the bottom end. Long lower shadows are really bullish at the low end of things. Long upper shadows are a lot more bearish than long lower shadows are. You typically don't get very long upper shadows though, because volatility is lower on the upside than it is on the downside. But you can see after a bearish candle last week, we had a relatively bearish candle. We did bounce back up. Today, a really small range compared to last week, and we got an overbought cluster. Not on a daily chart this time, but on a weekly chart. And not only a cluster with all three of these lines, but also you can see with market sentiment up above 82. That's a very significant pattern. And as you see, the last time we had that, now we had that before over here, we didn't have market sentiment above 80, and we were closer to the beginnings of a bullish intermediate run. We've been on this bullish intermediate run now for NextEra since beginning of 2017. We've gone from 120 up to 170. during this rally. You can see it's a long rally compared to other ones like this one that we had in 2016 before we broke down. And no cluster over here, we just broke down. Over here we got the cluster, and you can see how, you know, after a few weeks it broke down as well and started more of a bearish run where market sentiment fell for quite a while. So after market sentiment rising above 50 here, there's the run that Nextera's had, and the overbought cluster would suggest that that run may be ending, especially with rising yields, right? With the drop, a big drop we had, a big bearish drop that we had on long-term on TLT. If you look at what that looks like on the daily chart, you know, last week and this week, here we go. You can see the big bearish move we had to the downside. We did bounce back up, and then there's our flat move here this week. Long upper shadow yesterday. You can, again, we would expect this to hold this resistance level, move back down if yields continue to make the run to the upside. Again, reminder what yields are, and starting to make a run and getting above, and you can see the the intermediate line turning up here. And you can also see from a 3 green arrow perspective, TNX getting that 3 green arrows now, the crossing above the 6-week moving average, MACD and stochastics rising. If you look at it on the 2-line version of that same chart, you can see how the 8-day real close to crossing above the 17-day. That's when the MACD crosses above 0 there. Stochastics crossing above 50, moving up to the upper half of the chart. So yields, you know, have based and bottomed out and now appear to be potentially rolling back up. And like I said, not a good development for stocks like Nextera, which has been so bullish and has been losing that momentum. Its stochastics, or MACD is below its moving average. Stochastics forming what could be a divergent high point here, and potentially rolling below its moving average. So that being said, we don't want to be too aggressively bearish like buying a put, but we can look at selling a call vertical at the 170, 175. You're getting a lot of premiums. Even it's a wider spread. It's an expensive stock. So you have to kind of fiddle around to see where you get filled in. That these are relatively wide spreads, especially on the long option here. Closer at the money. Well, this is the at the money option. You can see it's, well, you got 15, 65 cents spread. See how wide that gets once the market actually opens up on Monday. So you have to kind of fiddle around to see what you get. The $1.16, the $1.20 is the 30% return on risk that you'd shoot for. And again, 170, where's that 170 level? It's right there. It's at these highs. So if we hold these highs, you expect it to drop back down. Considering the wider spread, considering the trend, the expectations are weak for this, but considering the risk factors involved, and you can see that it is a $5 wide spread, so it's $335 per contract, per spread to get into this. But you get, you know, the $165 if that's the credit you end up getting for that risk. And you can see if we do break up above these old high points, to keep our losses to $165, you know, you'd be right around on a day-to-day basis, be right here about 175, and that's going to slowly move up. Down. That's going to move down as time passes because there's negative time decay there. So if we break above those highs, we want to close out and keep our losses to $165 or less if it breaks above those highs. That's how you'd manage your risk. Now, again, the spreads are wide, so we're going to keep, instead of, we normally do a 1% of our portfolio. If we got a $100,000 portfolio, we'd risk $1,000. Considering the risk factors of the wider spread, and because we don't want to take a full maximum loss, but that the potential of doing that's higher, the trend in the wider spreads, then we're going to cut that and not only just in half like we would normally, but we're just only going to do one spread on this and keep our loss to $335. Keep it small, keep it safe, but give us something, first of all, bearish, which we've had a lot of bullish trade ideas here on the market outlook over the past so many weeks. So this would be a bearish trade that kind of balance and bring a little bit of balance to the portfolio, but in a sector that we would expect to be weaker with the rise in yields, in a stock that has really, really done well and is showing some strong overbought patterns and some potential reversal candlestick patterns as well that would suggest a downside move. So it's not an aggressive bearish trade. It's just something that gives us a little bit of negative delta to an active trading portfolio that has been pretty heavily positive delta here lately with the different trade ideas that we've had. All right, so what do you think? I'd love to hear your thoughts. There's a link popping out that takes you to our Market Outlook forums on marketscholars.com. Click on that link. Let me know your thoughts on today's trade idea. Do you agree? Do you disagree? What do you think about the market posture right now? What's driving the markets? So love to see your comments there. Thank you very much for watching tonight. I appreciate your time. Remember to subscribe to our YouTube channel if you haven't already. Like today's video by clicking the thumbs up icon and comment. Follow me on Twitter if for more content like this throughout the day, throughout the week. Also remember to join our Market Outlook community on Facebook. That being said, have a great weekend, everybody, and we'll see you all on Monday.